This event is brought to you by TradeOutLoud and Timing Research. David and I are going to try to do a good job as a host. Don't forget that you're risking real money, and none of the information is for educational purpose only. So none of the information should be used for trading or investing, and it's for education purpose only. So AJ, I don't want to take up your time. You can go ahead whenever you're ready.
So like I was saying, hi everybody, this is AJ Brown. And I was saying a little bit earlier, if you caught on, if you were tuned in a little bit early and heard some of the banter back and forth between Anka, David, and I, that I really enjoy being invited to these events because they have a theme to them. And so I actually decided, some of you have probably heard of me before and heard me speak before, but I actually decided that I'm not going to be pitching anything today. In fact, I'm going to, at the end of this presentation, be giving you a free tool to help you decide what sort of options to trade when you have a tradable pattern. And so I want to make sure you tune in and you take a lot of notes, because all I'm going to be doing is kind of teaching, and I'm going to be giving you a heck ton of content. And so I want to make sure that you're taking some notes. So you take a moment and grab some pieces of paper and pencil, or if you've got some digital ways of taking notes, do that. And yeah, get as much out of my presentation as you can. Like I said, I'm not here to pitch you anything today. So I put in a couple of slides, but mostly we're going to be working and actually looking at live examples. So let me just go through my slides really quick. First of all, we all have mentors, even the folks, I've been doing this since 2003. I have a company called Trading Trainer, and we've been teaching folks how to trade equity options and equities since 2003. But even us folks that have been teaching for as long as I have also have our own mentors. And I follow my mentor on Facebook, and just a few days ago, he posted this, and I thought it was just perfect. He said, "I just hate to be the guy to break this to you, but most of the self-described experts out there have their heads firmly up their butts." He said, you can read what he said. There are shortcuts to success, and I just wanted to emphasize that because I'm going to show you some shortcuts to picking some options today for trading, but none of them involve magic. And shame on you if you get involved in some scheme that you just know sounds too good to be true. So I thought that was just so timely, because I've seen so many folks appear in this space of offering tools and offering education on investing, and they're always promising the world. And just trust your gut. If it sounds too good to be true, it probably is. Now, I've dissected one of the things I do on the side, and I have one of the benefits is because I'm involved in this space as a teacher, I get to meet other people who are teachers, and you kind of get to find out who actually is somebody who practices what they preach, right? And I try not to affiliate myself with anybody who doesn't practice what they preach. And so when I find somebody who I know has been very successful at investing and trading, I always like to interview them. And I've been collecting these interviews for over 20 years now. And one of these days I've threatened to put them all into a book. I just haven't have the time with everything that I've been doing recently. But on the side, I've kind of figured out, what it is that all of these successful investors and traders have in common. Number one is they really focus on managing risk. When they go into a position, the first thing on their mind is managing risk. They don't look at the rewards until they have logged and closed the position, and then they count the rewards after the fact. But when it comes to planning, it's all about planning around risk. The other thing that they all have a way of really paying attention to is what I call pattern recognition. No investor goes at the markets or at a trade or at a position with a certain strategy in mind in advance. Instead, successful investors or traders take inventory of what they're looking at first, and they identify all the different patterns out there that they see, and then from there they come up with a plan, right? They don't do it the other way. They don't come with a plan and try to fit it to a pattern, because that's just a recipe for success. And by the way, all of these are very much newbie mistakes. When you have a new investor or trader, you often see them not taking, not being aware of risk, and instead having big eyes looking at potential rewards. You notice that sometimes they're like, hey, I know how to do vertical spreads, right? Like, and I'm going to just trade this no matter what the pattern is. And vertical spreads only work in a particular pattern. That's just an example. But I've had so many investors over the last 2 decades come up to me and say, man, I took this short course on how to learn how to trade and fill in the blank: vertical spreads, covered calls, leveraged options, even just stocks or Forex. And the first 10 months, it was working perfectly. I was making over double-digit returns on my portfolio every month. But something happened in month 11 where I just did the same thing as I've always done with the vertical spread, but I lost not only all the gains I made in the first 10 months, but I lost half my portfolio as well. And I don't know what I did wrong. Well, obviously the patterns changed and you didn't, right? You can't apply the same strategy, the same trading strategy to every pattern. You have to be able to do pattern recognition first, and then look in your trading tool chest for the correct strategy or investment vehicle or whatever to take advantage of that pattern, which is the next piece. Successful investors seem to always have an idea of how to pick the right strategy or investment vehicle in order to match the pattern. In fact, this is what I'm going to focus on a lot today. And the tool that I'm going to give you for free is all about investment vehicle selection, especially in the realm of options trading. I am going to throw a little bit of risk management in there as well. Finally, the last one is timing. And I know a lot of folks focus on timing, but timing is important, knowing when to do the buying and when to do the selling. But if you pick the wrong strategy or investment vehicle based on the pattern you've identified, the timing doesn't mean anything. You're going to wind up having a losing trade as well. So let's keep going a little bit, because I focus on equity options, and these things are so versatile, right? Not only do they profit when the market goes up, but they also, and they especially profit if the market goes down. And I know that with equities and many ETFs and indexes and stuff, you can short them. So you could also profit if the market goes down. But options do really well when the market goes sideways. In fact, options can also profit on simply time passing by. And options also, a lot of people don't really pay attention to this, but options profit if there is fear or confidence in the market, right? If there's fear in the market, options actually go up in value. If there's confidence in the market, options actually go down in value. And so it turns out that when you get into options, mathematicians have proven that there's 26 different ways to trade them versus like a stock. A stock you can trade either up or down, right? You can either go long or you can go short, 2 ways. So options are very versatile, but nothing comes for free. That versatility comes with a little bit of needing to master that flexibility. If you don't watch out, that flexibility can breed complexity. So I'm here to help you cut through that tape today. Now, let me ask this question. Do you guys even know who I am? I've been on a couple of these synergy trading events. I usually am talking about premium selling because that's one of my favorite option trading strategies out there. But just in case you don't know who I am, I'm going to flash these on the screen. And of course, you'll probably get an access to the replay for this. But you can easily use the tt4.me website and then just add YouTube or podcast or Facebook. We have a really fantastic live show we do every Friday at 11 a.m. Eastern time, 8 a.m. Pacific time. I also write a lot of technical articles and white papers. You're welcome to reach out to us and contact us, or even just phone us. You can subscribe to any of our social medias. That's cool. So I thought I'd flash that up there. And if you're watching the replay, you can pause and check this stuff out. And some of you, I think I already said, I founded Trading Trainer back in 2003. Folks like to refer to me as the world's most disciplined options trader. I think behind my back, they actually call me the laziest options trader. I like to think of myself as the most efficient options trader. And that's because I like to make reward with the least amount of effort, least amount of stress, least amount of white knuckling my chair as I hope the position goes my way, and the least amount, of course, investment dollar. And so I focus so much on that parameter of efficiency, right? Because a lot of folks just focus on reward, and you wind up doing best depending on how you're measured. For some of you in the corporate world, you might have heard that before. You measure somebody a certain way, and that's how they're going to perform. Well, I like to measure myself on efficiency, getting the best return on investment. I've been doing this since 1997. I've been publishing daily insights for my program participants since 2002. There's an ebook that's circulated, I think it's over 2 million times now, that I wrote back in the day called The 7 Strategies of Successful Options Traders. You probably have that on your computer. I have this home study course that we've sold out many times. We've sold over 10,000 copies of this thing. And my favorite thing that I like to toot before we get back to the content of this presentation is that I started a foundation. I take historically underserved inner city kids off the street and I teach them how to invest. I started back in 2003 with a group of 9 folks that, the scoop is we only could use the public library. And the public library back in 2003 limited us to only being on the computer for 60 minutes a day. And so I taught these folks how to do investing with that limitation. And at the end of my 6-month program, I gave them each $2,000 of my own dollars. I thought I would be just writing it off as kind of a charity expense, but it turns out every single one of them paid me back. Most of them were able to then use their additional profits and buy themselves, their own trading computers. One of them has graduated DU at this point. These folks are now pretty much in their late 30s, early 40s. And it's very, very cool to see the success. We are getting back into, we had to take a pause because of the pandemic, but we're getting back into live trainings again for these kids. And we now do them in Chicago. And we've partnered with the CBOE in delivering this. And the last time we did this live, we had over 400 kids come through our program. So this is my claim to fame. This is what I care mostly about. And so I just like to toot my own horn. I think this is awesome. So let's get back to the content, shall we? So when you look at an option price, like if I pull over an option chain, and I'm just going to be using the Thinkorswim software today, but option chain software, you can find this for free on the web. If I pull over an option chain and look up at any individual option, I'm looking at the Nike July options right now. You can see that the price of the option halfway between the bid-ask price is called the mark price. This is a combination of 2 components, the intrinsic and extrinsic. In other words, you take those 2 components of price, add them together, and you'll get the current traded price. Or if you reverse engineer it, if you look at the current traded price and you subtract one or the other away from it, you'll get the opposite, right? So option price is equal to the in-the-money value plus the premium value. Now, those are the names I use. The actual academic names for these things is the intrinsic and the extrinsic, but I call them in the money and premium value. Some people actually call premium value time value. You'll never hear me say that because that value has so much more in it than just time, right? So intrinsic and extrinsic value, two components of price, right? So you might say, okay, what does this all mean? What are these two components that make up an option price? And I'm getting into kind of the nuances of options that folks don't take advantage of. The in the money value or intrinsic value, it is affected by the type of option it is. So if it's a call or a put, that will affect the intrinsic value or the in the money value. Also, the strike price of the option will affect its intrinsic value and the underlying symbol price. Now you'll notice that I put a big fat asterisk over here on this underlying symbol price. That's because the option does not change at all a call or a put. Once it's born a call or a put, it is a call or a put its whole life. And there's only the rarest of rarest situation where a strike price might change if a stock perhaps splits or reverse splits, but otherwise strike prices don't change. And so the scoop is the only thing really that is a variable that changes over the life of the option is the underlying symbol price. And that's the only variable that really affects the in the money value and makes it move over time. So that's something to pay attention to. Now that other component, the premium value, or the academic name is the extrinsic value, it's also affected by strike price. And you'll notice it's also affected by the expiration date of the option. The underlying symbol price, I put that big fat asterisk there again, because again, strike price and expiration date of an option don't change over its life, but the underlying symbol price could. And you'll also notice that it's affected by whatever the current date and time is. More importantly, it's affected by how many days to expiration, right? So if you take the current date and time and the expiration date, this affects the premium value. It doesn't affect the in the money value, but it affects the premium value. And you'll notice implied volatility affects the premium value. And also the risk-free interest rate. Now, we haven't actually had to think about this much over the last 15 years. And that's because our central bank here in the States has kept the risk-free interest rate to almost nil. Even at a point where they were starting to raise rates, it never got very high. But we're starting to think about how the risk-free interest rate affects the premium value of an option, because it is rumored that we're going to be getting a lot of interest rate hikes over the next couple of years. So keep that in mind. So the premium value is affected by a lot more variables. Every single one of these variables that I marked with an asterisk can change over the life of the option. So the premium value is a lot more hard to kind of nail down than the in the money value, right? Doesn't mean you can't nail it down. In fact, I'm going to show you a way to get a better grasp of the overall piece, but I wanted to make sure you kind of understand this piece. In fact, a lot of traders who are good at finding patterns in stock charts, like for instance, if I bring you back to my Thinkorswim, and I'm going to be telling you about a trade I did on Nike. You know, I identified around March 31st that Nike might move for a few days in the down direction. And it turned out I was right. And I actually made a nice chunk on this trade. But now, if you identify this pattern and you don't know how to do good option selection to take advantage of that pattern, all you know is that maybe you should trade a put because puts make money when the stock goes down. But you don't know which strike price or expiration date to choose. And that can change the personality of an option quite drastically. So what a lot of traders who don't understand how to select options, they'll just default to using an option trading at parity. So what does that mean? That means that option premium component, that one that was affected by like everything, it's at its most when an option is at the money. But when we go deep in the money, the option has very little premium. In fact, when we're actually trying to find options trading at parity, we evaluate the premium of compared to the overall price, and we try to get an option that has less than 5% premium. Therefore, it's almost completely that intrinsic value or in the money value that I've been talking about. And that means that deep in the money option behaves exactly like the underlying security. If the stock goes up $1, then so will the option. If the stock goes down $1, so will the option. So a lot of traders go for this trading at parity. They can use the leverage component of an option. And let me show you quickly how you can evaluate that, because this is something you can do on your own very easily with a calculator. Now, you'll notice that this option chain, I've added some columns, and no matter what you use, whether it's Tastyworks or TradeStation or OptionView or the CBOE or whatever, oftentimes you can add some additional data columns, and I recommend you do this. So pay some attention. I'd like you to add definitely open interest and volume. Make sure you're looking at the open interest and volume. We're going to talk a little bit about liquidity in a couple moments. You'll want, of course, the bid-ask spread of the option. But in addition, make sure you're looking at the mark price, the implied volatility, and then the intrinsic and extrinsic prices. So if you're looking for an option trading at parity, simply grab a calculator. I'm pulling one up now right on my computer. And divide the extrinsic value by the mark value and look for less than 5%. So let's do it. If I'm looking at these July options, let's see if we can find one that's less than 5%. So I'm going to start here with maybe the 100 strike price. I can see the extrinsic value is $1.11.5, and the mark price is $38.30, $38.20. It's moving as we have our live section. In fact, I can stabilize this by looking at yesterday's close price. That way we won't have a moving target. So Nike, and we'll look at these July options. And again, I'll start with the 100 here. Let's take this extrinsic value. Make sure I highlight it so I can see what I'm doing. And the extrinsic value at the end of close yesterday was $1.32.5, and just divide that by the mark price, 38.375. This one's 3.5%. So this meets our definition. And if the stock is trading at $137.05 a share, this option is only trading at $38.38 a share. And I'm going to have the same sort of almost dollar for dollar movement by picking this option. In fact, I could probably, based on this, let's see what the next one is. if I say $1.17.5 divided by 33.225, I still have 3.5%. In fact, I can keep going until I get really close to that 5%. Now, the academic definition, that one overdid it. So this was the 110 went to 6%, 5.9%. So maybe I want to use the 105 or the 100 strike price option. And as far as expiration date goes, the expiration date, now that I've got an option trading at parity, it's not going to affect the price because the premium component is so small of the overall price that time passing by is not going to be affecting my price, but instead I just need an option that's going to outlast my trade. So if my trade's going to last, my position seems like it'll be done before July 15th, I can use the July 15 option. So this is one way to trade, is to just use options trading at parity and then trade the way that you would trade a stock. If you find a pattern and the entry and exit signals, you just use an option trading at parity. But you miss a lot of kind of the nuances of using options, right? You can really, if you pick the right option, get it to be turbocharged if the position goes your way, and to limit risk if it doesn't go that way. So trading at parity is one way to do it if you just want to make an option one-dimensional so it acts and behaves like the stock and you're just taking advantage of the leverage. But there's so much more to options, and that's when people start getting into these option profit and loss diagrams. So let me just go over these very quickly because it seems complicated, but it really isn't. Whenever you look at an option profit and loss diagram, by the way, a lot of folks also will call these risk reward graphs, or even just risk graphs. I totally write like my college university professors used to write on the board, but you get what I'm saying, risk reward graph. When you look at these things, first of all, realize that the horizontal or x-axis is the independent variable, and that's going to be the underlying symbol. And that could be a stock, an ETF, an index, whatever its price is going to be along the horizontal axis. And whatever's on the vertical axis, the y-axis, that's always going to be the dependent variable. And so in this case, it's going to be your option strategy price. And so whether you're profiting or losing, this would be a profit, this would be a loss, or this would be a reward, and this would be a risk, depends on where your break-even price is. And so, for instance, if I was to put a profit and loss diagram of a simple call option, a call option is its intrinsic value is worth nothing at, if it's out of the money. And then once it hits the strike price, once the underlying symbol is above the strike price, it starts to gain in value. So that's the intrinsic value. And of course, you pay something for these options. And so whatever you pay, you do have to recover in its value in order for it to begin profiting for you. So that's what I'm showing here. I paid this amount to buy this call option. And so I have to make sure that this call option starts profiting. But in addition, there's that extrinsic value. And that extrinsic value lives on top of the option. In fact, remember we were just talking about an option trading at parity. We talked about going really deep in the money. That's like picking an option that's so deep in the money, it's up here, where this extrinsic value, which tapers off in both directions, is less than 5% of the value, and the rest of the option price is the intrinsic. and that intrinsic moves dollar for dollar with the underlying symbols. That's like the easy way out. But what if we can master that extrinsic value? So the total value of that option, or the price of that option, you have to factor in that extrinsic. So let's look at one of these risk graphs. I'm actually going to pull up a real example. So I'm going to pull up some puts. So this is a little bit different. Actually, I'm going to pull up some calls because Nike is on its way up. And so why don't we look at some calls here? So let's see, where do I think it's going to go up to? I don't know. Let's say it won't top 150 before it pulls back. So I'm going to pick the 150 strike price. And I'll go ahead and show that I'm buying these things. And I'm only going to look at a single contract in this example. And I'll look at the July, and I'll also look at the September. So September 150. In fact, I'm going to tweak, it comes in at the ask price, 540 here. Let me actually lock these in on the live trading here, on the actual mark here. So I'm going to put this guy here, and I'm going to make it for the mark price, $3.2250, $3.22.5. And so you can do this too, not 3,000, $3.22.5. Boom. And let's do the same thing with our September option, 150 strike price, and I'll bump that price to the mark price, 520. Cool. So let's look first at the July option using this risk graph. Now, does this look familiar? It should. This is exactly what I was showing you in my slide. This blue line represents the intrinsic value, and this purple or magenta line represents the price, and what's in between those two is that premium component, right? Along the bottom, or the x-axis, you can see we've got the stock price for Nike, and this is the amount of profit or loss that we would make on a single contract. I'm looking at 10 contracts here, but I'm going to go ahead and click it down to just a single contract. I want to focus my mind on just a single contract. And you'll notice I've got two contracts, two different options down here, but I've only checked one of them. And so it's only showing me the risk graph for the one I check. If I want to look at the other one, I can check that one. Right. And so first off, looking at these two options, the first thing you noticed is that the pink area, when I switched over to the September option, got bigger. And that's because as we go farther from expiration, the value gets more. In fact, let's take a look at that even closer. I'm going to switch back to my July option. You can see the September has way more value. Let me shrink this down so you can see it a little bit better. There we go. Look at what happens. So this cool tool, and again, whatever options analysis software you use, they all are similar. I can, with my calendar, I can show you that as time goes on, let me go ahead and come back to today's date, and I'm going to mark this. Say, for instance, I bought this option at this price, and the stock underneath it decides to stay where it is, go sideways. It decides not to move at all. Look at what happens to the option price as time goes by. So you'll notice that the option price decays away. Now, if I was up here deep in the money, you'll notice that the pink decays away, but there's so little pink that it doesn't actually affect the option price much. But if I'm out of the money like I am here, you'll see that it gets significant. In fact, the other thing I want you to notice is, notice how that pink line isn't just, when I first started and I was just around the April 20, it wasn't moving very fast at all. But as I get closer to expiration, it seems to be losing value even faster. In fact, it is, until finally at expiration, there's no extrinsic value left at all. Extrinsic value. In fact, another name for the intrinsic value or in the money value is the value of the option at expiration. That extrinsic value decays away with time. So you need to have your pulse on that. And using this tool, you can get an idea of how time passing by could affect your option. I'm going to bring us back to April 20. But what another aspect that we talked about was implied volatility and how implied volatility can affect your option price. Implied volatility means that when folks are worried about what their stock might do in the future, they buy options as hedges. And so when they buy options as hedges, there's a demand for the option, and therefore the option goes up in price, because whenever there's a demand for something, think about the supply and demand for gasoline at the gas pump right now. There's more demand than there is supply, and look what's happening to price. When there's more demand for the options than there are options, the implied volatility goes up. And so you'll notice that as I raise the implied volatility, its value is going up and down. As I lower the implied volatility, it goes down. So if you're going to be trying to figure out what's happening with your option or what will happen with your option, it's important to get kind of an idea of what might happen over the life of your position with respect to volatility. And this is one of the big gotchas. One of the big gotchas that option traders don't pay attention to is implied volatility. And so they'll get into a trade thinking that if the underlying symbol goes their way, that they'll make money. But the combination of time passing by and changes in implied volatility could totally surprise a trader. And so these risk graphs are pretty cool. By the way, there's a bunch of different mathematical models. You can see this particular software. This is the Thinkorswim software from TD Ameritrade Schwab. Has these three different models. Honestly, they're very similar. And unless you're getting down into the nuances, you can just use the default one for what we're doing. But I need you to pay attention to, when you're analyzing your option, the date and the volatility adjustment. And if you think that the Fed's going to be raising some interest rates along your life of your position, you may want to clock that in. Make sure when you're looking at different options, you also are aware of what price you're looking at of that option and what the stock price is at the time, because that's going to make a difference on your analysis as well. But you could totally clock these things in and say, listen, I'm going to be, based on some of my back testing or based on the patterns in the past, if I'm looking at this uptrend, I can just look at a couple of these other ones in the past. And again, that's not the subject of this presentation, because I'm assuming that if you're going to be using options on a pattern, you guys know how to evaluate the patterns, whether it's a swing trade or a trend following trade, and get your signals. But when I'm picking out an option, I can look at some of these last times that it did similar movements, and I can say, okay, here's the pattern start date, here's the pattern end date. I could also look at when I've gotten signals, and instead of the symbol going the way I wanted it to, it stalled. So one of the things I would ask myself if I'm going to be using options that are other than options trading at parity would be, how long would I stay in this position, especially if it doesn't do what it's supposed to do? So it looks like here we've got probably about 3 to 4 weeks of trading days, so about 20 trading days. This one maybe is about 15 trading days. And so being aware of that, and I would say to you, please write this down, error to the side of more days than less days when you're doing your analysis. When you're evaluating what's the worst case scenario, error to the side of more days in the trade, because you'd rather plan for the worst and have something go better than plan for the best and have it go bad on you in the field. Does that make sense? So evaluate the number of days you'll probably want to be in the position, especially if it decides not to go the way you expected it to. Plan and understand, like, for instance, if it doesn't go the way you expected to, where would you, trigger a risk bailout? In other words, on this particular symbol, it looks like my lows over here were 144, 139. This low was 140.61. So maybe I'd want to bail out if I was in this trade again at 140. Maybe if I had been in this trade, maybe 125 or 124. So you'll want to know that price as well. Where would I bail out from this? What underlying symbol movement would cause me to say this trade's not going my way? How long? And then also we can look at these previous patterns and monitor similar options, find similar options to the one that we're going to be trading now, the one we're interested in trading now. And we can use a historical. So I'm going to come over here, and most of these option softwares have a way to look at historical. This is where the implied volatility comes in. You can go back to those dates and you can look at the similar option to the one you're thinking of trading, and you can observe as you trace through that pattern what happens to the implied volatility. In other words, I can set, using my historical options lookup, the date, and then I can follow that implied volatility. Sorry, I circled the wrong thing over there. My implied volatility on my calls is right here. And so I can observe and see what that similar option did in a worst case scenario simply by using these tools to step through and monitor what is happening with the implied volatility of the similar options. And that way, when I come back to my risk profile, I can type that all in. I can say, I want to go out from today's date. If I trade this today, I want to go out about 4 weeks. I want to error, write this down, error to more time than less time. In the worst case scenario, I see volatility on this particular option dropping 2%. And now you can go to that bailout price. For instance, we were talking about $123, and you can get an idea of what sort of risk you're opening yourself up to. I'll put my cursor. You'll notice the bottom number is the underlying symbol price. So at $123 for a single contract, I can expect about a $300 loss. So now you can compare that with, for instance, the September option and see how much loss you would be expecting there. That's managing risk in your planning. In fact, if we go the next step, I'll bring us back to the slide. If you can determine what is the worst case of your investment, what's the worst case scenario? How much could you max lose in your position. That's the risk of the investment. And you know how much of your portfolio you want to invest, you can calculate how much of your portfolio will be at risk. Or you can use a little bit of algebra, and you can say to yourself, that risk of the investment is equal to the risk of the portfolio divided by the size of the investment. Or more importantly, you can come to this final formula. You want to write this one down right now. You can determine how much of your portfolio you should invest by taking how much of your portfolio you're ready to risk and divide it by the risk of the investment. So for instance, if you're only willing to risk 2% of your portfolio, if everything goes haywire and the trade completely goes against you, you only want to put 2% of your portfolio up for risk. And you know that the risk of your investment, if everything goes against you, it would lose 8%. Then this formula would tell you that, well, then if that's the case, only invest 25% of your portfolio in this particular position. That way, you'll limit the risk of any one position to what you want to open your portfolio to. In fact, I have some numbers for you. You may want to write these down. If your portfolio is less than $5,000, I have found that you don't want to risk any more than 4% of your portfolio on a given trade. If you have a little bit bigger portfolio, $5,000 to $25,000, drop that down to 3%. In fact, if you have $25,000 to $250,000, don't risk any more than 2%. Now, these are numbers that I give my program participants. You're definitely open to do whatever you want, but I have found that this works really well. In fact, think of it. If your portfolio is less than $5,000, you're going to probably be a little bit more aggressive, as you can see here, but you'd still have to really screw up 25 trades in a row before you wipe yourself out. None of this stuff where you come up to me at a speaking event and you say, I don't know what happened on the 11th month, but not only did I lose all the gains from the prior 10 months, but I lost half my portfolio. If you manage your risk from the get-go in your trade planning, there's no way that you can lose in one position more than 4% of your portfolio. None of this 50% loss stuff. In fact, here's a hot tip. If you're bailed out of your positions more than 3 times a row, stop what you're doing, take inventory, and reassess. And that's because if this happens to you where your trades bomb out completely, the worst case scenario is realized, then it's really not the market throwing something unexpected to you. It's more about how you see and you're interpreting these investable patterns. Or it could be how you're planning these trades. And it means you need more knowledge, more experience, and more practice. Does that make sense? In other words, I call it the hat trick. If you screw up royally 3 times in a row, it's not the market, it's you. So go back to practicing. The beautiful thing about investing in the markets is we have paper trading and simulator trading accounts. You can't do that in any other money-making type thing. You can't have a simulator Taco Bell and run it simulated. Like, you can't simulate buying a piece of real estate to see how it works out, but you can definitely do it with options, equities, ETFs, in indexes. One more thing I want to point out is options, different than many of the equities and indexes and ETFs. We create the options, traders like you and I. The OIC puts together the marketplace, but we are the ones who actually create the options. And so liquidity becomes an issue. So look at the open interest, write this down. If your open interest is less than 100, beware. I get the heebie-jeebies if the open interest. It means that you could actually go, and if you want to buy or sell an option, it might be a little bit difficult. You might not get your order filled at the price you want. In fact, I would say if the option open interest is less than 50 and you're expecting to be able to buy and sell this, it's not going to happen. So don't trade options with less than an open interest of 50. And one other rule that I have is if you're starting to trade bigger positions, like positions that are over 5 contracts, don't trade more than 10% of an option's open interest. Again, this all has to do with liquidity. Open interest, by the way, is not the end all to be all, but it is a good starting place. Also evaluate the bid-ask spread. Make sure that bid-ask spread it agrees with what the open interest is telling you. The market makers set the bid-ask spread. Trust them. They know more about this stuff than we ever will. So let me show you this tool I'm going to give you. So I showed you how to look up all this stuff. This tool I'm going to give you is a really well done spreadsheet where you can compare up to 5 different options. And so you put in the amount of the cash value of your portfolio. You put in how much you're willing to lose on a particular trade, the max allowable loss. Then you put in the statistics of the individual options. What's the option name? This is the Nike. You see the expiration date, 15 July 2022, 105 put. This is the September. This is the price of that option. You just grab this from your options software. The open interest. You put in those details that you're going to put into your risk tool. So the date, and actually the date, how far out in time. This is the worst case scenario that you're putting in the specifics for. How long would you wait? Now, I did this on March 31st. And so I was willing to wait about 22 days for my trade to work out. And if it didn't work out, I'd get out. So I put that date. Now, you'll notice in the notes here, it says error farther out in time. The volatility adjustment, the underlying symbol price. And then I just put my cursor over that risk graph and determine the max loss for one contract. And look at what it does. It calculates based on your portfolio specifics how many contracts you should trade. It does that risk management for you. And it also will adjust that. You can see here on this particular July option, there's plenty of open interest. But what if I had only 95 open interest? It's warning me. It's like open interest less than 100. What if I had less than 60? What if I had less than 55? Notice what it did here. It says, hey, your contracts are less than 10%, and it adjusted. So not only is this tool calculating your risk, it's also calculating based on the liquidity of the option, how you should size your position. In fact, if you go below 50, it's going to tell you not to do it, right? If you have 49, it's like, hey, don't do it. There's not enough liquidity. It's built into the tool. The other thing is you can also analyze the more realistic situation, put in the same details on that risk graph, but this is the more realistic situation. You don't want to do the best case because you want to be surprised in the positive, but this is the realistic case. And now you can start to compare risk versus reward. And I wound up using the September option because I was risking the same amount of my portfolio, 1.7%, but the potential reward was going to be a couple of tenths of percent higher. And I wound up killing it with that trade. So how can you get this tool? And also, how can you learn how to use it? Because it will tell you, or I have a tutorial. It's easy. I'm going to give you a website that you go to. Give me one here, and that'll be the end of my presentation. Go to optioninvesting.org/synergy. If you've got a mobile phone, you can just scan this QR code. Optioninvesting.org/synergy. And it'll give you free access to my web portal. Just put in a username and a password and get yourself free access to my portal. Once you're in that portal, you'll come to the home page. I'm just bringing over what it's going to look like for you. And scroll down. There's a whole bunch of other stuff in there that I give people for free too when they get access. There's a short course on selling cash secured puts. There's index stats tool. There's white papers, but there's also this options analysis. This is the tool. Click download here, and you'll notice that in addition to being able to download the tool, there's a very thorough tutorial on how to use the tool. Don't make selecting options just guesswork. And you can do better than just trading at parity. It only takes a few extra moments, and with this tool, you'll be able to compare up to 5 different options and find the best option that'll give you the most reward for the least amount of risk. This is my gift to you, and I hope you enjoyed my presentation. I really enjoyed being part of this, and I'm going to hand control back to Anka and David.